Can you hear me okay? My condolences. Kathleen's great. I can't do what she does. I'm too much of a simpleton. If I had a strength, it's that I know I can't do too much and that I'm a simpleton. I do a lot of stuff, so if you're interested in any of the stuff that I do, you can follow me on Twitter. I'm very active on Twitter. Next Monday, I'm off and on a pretty much regular on Neil Cavuto's show on Fox, and I'll be there next Monday. It's pretty easy to know what I think, so people ask me, what do I think? And that tells me they haven't paid attention to me because I'm saying it all the time. Let me try to make it really simple. And then you can leave if you want, which most people won't after I've been speaking for about 90 seconds. This is an okay but not great world that people think of as very troubled. And the spread is positive for markets. Markets live on the spread between expectations and future realities. Markets pre-price all widely known information. All the stuff you read about, hear about, talk about commonly with your friends and relatives, and is spouted on the media all the time is pre-priced. It's the difference between that and what happens in the future that moves pricing. Intuitively, you know that. If you don't know that, you need to come to learn that. The fact is, you get a lot of stuff that people talk about a lot, and it's mostly just a waste of your time. Let me give you an example. Any president that you've ever lived through, did you know anything about them that other people didn't know? Almost no one that I've ever met has. You follow that? Your opinions about them are similar and dissimilar to other people's. And all of those opinions are pre-priced. Some of you, for example, may like the current president. Some of you hate the current president. I've read in the newspaper that both of those are pretty common. And yet I'm going to bet you $1 to a donut that none of you actually know anything about the president that other people don't know. Therefore, to try to put that into pricing is a mistake. Now, mind you, everything about things like presidents and congresses and governments and all that stuff has a lot of power and impact on things that don't have to do with markets. And that's kind of none of my business. You follow that? And your social views are fine. I don't have a problem with them, whatever they are. But when you think about pricing, if you think, boy, I think Trump is wonderful or I think he's terrible, and therefore that's going to be what moves markets, it doesn't. So let me see if I can figure out how to move this advancer here. The big green arrow. Yeah, so let me make a point to you about how markets work. I'd rather talk to you about how markets work more than talk to you about what will happen. I've already told you what will happen. Tried to make it really simple. But people think like farmers. We come from a biological background that was rural and agrarian for thousands of years, hunting and gathering, and then farming. And we believe things normally like the weather in Philadelphia metro at a certain time of the year will fall largely within this bandwidth. And we expect it, if we had to make a wild guess 12 months forward, to be about the average of that bandwidth. And when we were wrong, we wouldn't be terribly far wrong because we know what the bandwidth is. Markets aren't like that. Average returns are not normal. Normal returns are extreme, and the average is an average made up of extreme returns. So here what you see in the center outside of those two red boxes is the number of years in the history of the S&P 500 where returns have been between 5 and 15%. And then to the right, where they've been higher or above average by a significant amount, and to the left, where they've been 5% to worse than that. And what I want you to see is how much more often they're either ugly or gorgeous, depending on what your view of ugly and gorgeous is. Beauty's in the eyes of the beholder, whether you're long or short. But if you're going to bet that the market's going to be average in terms of its average returns, most of the time you're wrong. So what you really want to do is sit there and say to yourself, what do expectations look for now? What are they thinking will happen? Do they think it will be good? Do they think it will be bad? Do they think it will be like this? Do they think it will be like that? And then say to yourself, if you forget about what they say and analyze what's there, what side is the surprise likely to be on? And my point would be, in my opinion, going back to my prior point, this is a world where sentiment's pretty ugly, and not just in America, but more so overseas, and of course markets are always global. People think it's a pretty darn lousy world, and it's actually an okay world. I don't want to get into any of the points that Kathleen was discussing, all of which were fine and right, but the fact is, as she alluded to, relative to numbers of countries, economies are growing where manufacturing isn't doing so well because in those countries services are much bigger than manufacturing. The services continue to grow. Overall, it's not a great world, but it's not a terrible world when people think it is. Now, in the course of this bull market, consistent with what I just showed you, we have this process which is true until it's not, as is the case in so many bull markets, where whenever we've hit new highs, we've run on to extended stretches of pretty strong advances for a pretty long period of time. Then we roll over again into a correction. We stagger around going sideways, and then we go, and when we hit new highs, we get another big advance. And that will go on until we get to, which maybe we have, because it's all about speculation at one level, until we get to the point where the bull market's over. You know this is the longest economic expansion in history. It's the longest bull market. It's also the most joyless. Grinding, long bull market followed by significant advances that don't last terribly long, then grinding periods that bring down sentiment. And when John Templeton said bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria, which is always right except when it's not. And usually it's right. You don't need to be a genius to look around the world and know we are a really long way away from euphoria right now. So you sit there and if this will go back, I think, there we go. So if you think of what I just showed you, what that would imply in a different way is that if the bull market's not over after a fairly long period of grinding, we're likely to come up in that box on the right side. If the bull market's over, we're likely to come up in the box on the left side. You follow that? And you got a choice to make. Everybody's got a choice to make. My bias is on the right side. I might be wrong. There's the data behind that. I'm not going to waste your time on it because I don't have that much time. But on average, once you hit new highs and you're in the bull market, you continue to get a pretty darn good advance in the next 12 and 18 months. And then that stops. The point that people get wrong in markets all the darn time is they think like farmers. We've already kind of done that a little, right? But the average returns aren't normal. Normal returns are extreme. Parallel feature, which is true about markets, is that the growth rate of the economy does not have a darn thing to do with what the stock market will do unless we're going to have recession. Higher growth rates, lower growth rates don't correlate with markedly different returns. Here you've got the bandwidth of negative growth rates, 0 to 2.5% growth, 2.5 to 5, and greater than 5, and what the market's done in those environments. And the reason this is true, I've already told you. Markets pre-price all widely known information, including all the opinions, and the opinions about the growth rates are already priced into the market. You follow that? It's a really simple point. Note that in this example, the highest growth rates don't have the highest returns. This is not the way a farmer would think. The farmer would think, if the weather's bad, it's going to be bad. If the weather's better, my crop's going to be better. And if the weather's perfect, I'm going to get the best harvest, right? And that works for that. It doesn't work for this. I categorically disagree with Kathleen about tariffs. I'm going to take you through this really quickly. But First, I'm going to say that in markets, as opposed to non-markets, there's 4 conditions to always keep in your mind. Fear of a false factor is always bullish because the fear is in the marketplace, and when it turns out to be false, that fear has to be reversed. You follow the simple logic of that? Hope of a false factor is always bearish, exactly the same logic in reverse. Those 2 are easy to get. The 2 that are a little harder to get is that big fear of a little negative is also bullish for the same reason, and big hope of a little positive is always bearish. And you always want to think when you're looking at stuff, which of those 4 it is. And pretty often it's totally false, and pretty often it's much ado about nothing, for good or for bad. So if we take, this is a column that I wrote in USA Today 13 months ago. You can look it up at the USA Today website or just do a Google search for it. If you look at that point in time, at the total amount of items globally that anybody in any country had talked about imposing tariffs on after 2017, it totaled $644 billion. The maximum tax rate that anybody had talked about putting any tariff on anything was 25% or less. Therefore, a tariff, being a tax, sort of a little like but different than a sales tax, would have at max, if all imposed, which many of them were not, and many of them will never be, if all collected, which many of them will not, and many of them will never be, if there was no substitution, the maximum tax would be $161 billion US. Now here's the only commercial advertisement I will make today. If you cannot calculate that $121 billion is 25% of $644 billion, then you really do need professional help with your investments. That was funny. You people don't have a sense of humor early in the morning. Now, the fact is, those are global, not just US. We got an $80 trillion global economy that last year was growing at about $4 trillion a year. So the max tax it could possibly be is $161 billion divided by 4, which is 4% of 1 year's growth rate. Negative? Yes. Big? No. In fact, tiny. Huge fear over a little negative. Now, I am prone to want to talk about heroin. You people just don't have a sense of humor this morning. If you believe that these tariffs would all ever be collected, then you don't believe the United Nations data that says that there's $50 billion of heroin illegally imported into America every single year. And you don't believe in black markets. A lot of these tariffs are easy to get around. Reshipping, relabeling, moving through third countries, through brokers. The soybean maker does not go and sell the soybeans to China. They sell them to a broker who sells them around the world, where they often never get off the ship and get repackaged and sold into someplace else for a 2% commission instead of a 15% tariff. Where there's a way to make money and picking up a spread, somebody's going to do it. Will some of those tariffs be collected? Yes. But can the World Trade Organization or countries individually control this? No, they cannot, because if they could, there wouldn't be the heroin that comes into America. You follow that? And all the rest of the black market activities. And if you believe otherwise, there's bridges people want to sell you. If we move from 13 months ago today and update these numbers, then you get to where instead of it being 4% of 1 year's growth rate, it's 16% of 1 year's growth rate globally. It's still a negative, but it's still a big fear over a little negative. Could Kathleen be right that this could be escalated into a big problem? Of course, it could. But at this point in time, it's big fear over a little negative. And again, there's evident examples of folks figuring out how to get around, businesses figuring out how to get around these tariffs, lots of ways. There's also free trade deals that have been going on that nobody talks about. Oops, I did that too fast. I want to talk about politics a little bit real quickly. Markets and politics don't work the way you think they do. You think like a farmer. You think this stuff's good, that stuff's bad. If they do this stuff I like, it'll be good for the economy, and it'll be good for the stock market. If they do this stuff I don't like, it'll be bad for the economy and bad for the stock market, right? That's not the way markets work. Markets pre-price all widely known information. So I'm going to show you something here, and I've used this visual for many, many, many years because capital markets always work the same way. Here we have the history of the S&P 500 since 1925, inception, arrayed by first, second, third, and fourth years of presidents' terms. Now, I'm not going to get into individual presidents, but the Republicans are color-coded in red and the Democrats in blue, which is standard color coding. And negative years are in red and positive years are in black, and you can intuitively see that most of the red years are in the first half of presidents' terms, right? If you can't see that, most of the rest of my visuals don't help you any. The fact of the matter is, I want to show you a way to think about this that's a little different than most people think about this. You kind of think, if this person's elected president, he's going to be good or bad for markets because of what he, or maybe in this next time, she would do. Fair enough? But you don't have any unique views that other people don't have, pro or con. And if you think this person, whoever it would be great for business or terrible for business, that tends to get pre-priced. Now, I don't know what's going to happen in one way to this election in 2020, but there's some things I'm pretty confident of. All of the aspirants to the Democratic nomination will funnel down early next year to one nominee. You follow that? Which reduces uncertainty. Because right now they make wild claims, trying to jockey for voter support. Eventually that comes down to one person and a two-person race, the Republican versus the Democrat. We do this always. And then the market tends to pre-price these notions. So if we're going to elect the one that everybody thinks is bad, whatever that means, that gets priced into the election year. Presidents never have as much power as people think they have. There's no president that you can think of in history that's lived up to all their campaign promises. Did you ever notice that? Because we have a system that's set up to stop them from doing it. The whole part about the system that's got the Congress and the courts and the this and the that, and there's just normal human inefficiency. So you take Democrats. Democrats are normally thought of as more anti-business than Republicans. Look at the inaugural year returns. Every single Democrat in the inaugural year has a double-digit positive return except for Jimmy Carter, who had a negative 7.9% return, a small decline. Why? And Jimmy Carter was thought of as one of the most business-friendly Democrats when he was elected. Why? Because the fear of them is pre-priced into the election year. And when the inaugural year comes, they can't do as much that's bad as the people that feared they would feared. You follow the simple logic of that. Pre-pricing, subsequent surprise. Flip that around to the Republicans. This is not saying Democrats are good or bad or that Republicans are good or bad. I don't want to go there. And I don't want to go into sociology. I got a lot of class and all of it's low. I got a lot of taste and all of it's bad. But I understand the simple ways markets work. So you think about notions of electing the one that people think of as more business friendly. That gets pre-priced into the election year. And then when the president can't do as much that's good for business, et cetera, as the people hoped, there's disappointment. So if you look at the Republicans in those years, almost all of the inaugural years of Republicans are negative. That's the disappointment that he wasn't as good as was expected of him from the positiveness in the election year. This is the third year of a presidential term. We haven't had a negative third year of a presidential term since 1939. And so as you went into the year, to expect that we would is a kind of a big order. To ask history to do something it's never done before it's possible, but it's extreme. This works because in the midterms we get gridlock or relative gridlock, and the way I want you to think about that is almost all major legislation in American history happens in the first 2 years of president's terms, because the president knows when elected that whatever would be the most onerous legislation he's got to do in the first 2 years, because his party, like in 2018, always loses some relative power to the opposition party, and whatever is the toughest stuff to get through, he's got to get it through while he's got the most power in Congress. So we move toward gridlock or relative gridlock, and I want you to think about that like that big legislation as this world where if I take from you to give to you, you hate it more than you like it. And you know that, right? Because people hate losses more than they like gains. Americans hate losses 2.5 times as much as they like gains. Europeans hate losses more than that. When we do it in politics, in public, we freak out everybody else because they think we're going to come and get them next. They think about the taking away, not the giving. And in the process of that, political risk aversion rises in the first 2 years when there's heavy legislation, like an obstacle course with big, sharp, fast-moving obstacles that businesses and you have to work your way through. Gridlock moves those obstacles to be more stationary, and markets move through them faster, and we never learn that lesson. It's just the way markets work. It's the way the world works. It doesn't take that much for the House to flip either way or for the Senate to flip either way in this election coming up, and I don't know which will happen, but what I'm going to tell you is the fear of it's going to be pre-priced. You follow that? Markets are better at doing this than our opinion is. Republicans have to pick up 18 seats to flip the House, which is about half, a little less than half of what the Democrats picked up last time. Might they? Might they not? I don't know. But it's not outside the realm of possibility. But next year, the market will figure it out before you do. You follow that? And if you think you will, you're arrogant. And you know what? I'm arrogant. And I know I can't figure it out. So if we take those years that I showed you before of inaugural returns, second-year returns, third-year and fourth-year returns, and instead of looking at them on an annual basis, we just look at how they progress weekly on average throughout the course of the year, you've got these 4 colors. And if you look at the third year, which is the one we're in, you typically see what we've seen this year, which is a rapid advance in the first half of the year, followed by more stagnation in the middle of the year, but not decline. And then when we look at the fourth year, the election year, we tend to start off not doing too much and accelerating in the back half of the year. What is this? Because this is what is normal in this sequence. What this is the aftermath of gridlock being imposed, surprising the first half of the year. The aspirants who want to take on the presidency, saying all kind of crazy stuff to get the nomination, which increases uncertainty and frightens a lot of people. Did you know that some of these people say a lot of stuff that frightens some of these people? I've heard some of the things that candidates are saying on the Democratic side, and they're all saying different things. Not all saying different things. Lots of them are saying different things. They need to if they want to break out of the pack, right? Does that make sense to you? That creates uncertainty, and it stagnates. It's a negative. It's a depressant on markets in the second half of the year. That continues as we move through the first half of the election year and we gain some certainty about who the nominees are, and then the market pre-prices the outcome. And I've studied this, and I'm certain it's true. When you get to the election, we always get a winner. There's no exceptions to that. And we will like the winner better than we think we do. So I'm just being told that I've talked too long. I normally do that. It's one of my basic features. I'm going to make one more point. In Europe, gridlock has emerged in a form that still to this moment no one recognizes. The EU elections have a long history of the year before the EU election, one every 5 years, just had one, having flattish returns for Europe. And that 12 months after, having very positive returns and beating the market. No one in Europe thinks about that. I believe I'm the only person that's ever in the world ever written about this feature, but I might be wrong about that. If you think of the way politics has worked in Europe, unlike America with the two-party system, you traditionally had center-left and center-right parties that made coalitions with like-minded or relatively like-minded parties to govern. There's been the rise of populism, which is misunderstood. It's thought of as one thing. Populism is really two things that oppose each other, populism of the right and populism of the left. And as that populism has risen, it's carved out the middle of the ideological bell curve of parties and destroyed the center-left and center-right parties in terms of their ability to create the governing coalitions that they used to create. And now they have to create coalitions with opposing parties. If you take the center-left and the center-right, they agree on a lot of stuff. If you take the populist right and the populist left, they agree on nothing other than that they hate the center. That's factual, and it's also funny. And it's been like a hand pushing down the center and up the edges. And there's no governments in Europe today that can legislate heavily on anything. We're all gridlocked. People don't recognize this yet, and it's a tremendously positive feature for Europe. Not so much for the economy as it is for the markets, in the same way as it is in American markets. I've now talked for a long time. I think I probably have time for one question if somebody has a question, which might be, why are you so stupid, Ken? Yes? You're going to hate this. I've never thought that the Business Roundtable had intelligent comments in my life. What about what they say isn't going to be pre-priced? You follow that? I'm not sure exactly which subset of the comments you're talking about, if it's the social policy portions or others. But in reality, I would view them at most as a coincident indicator. I would view them at least as friggin' idiots. Let me just, there's a part of me that this is not polite what I'm about to say. Most corporate CEOs are just basically a different form of politician and aren't worth beans and bananas. That's not true of all of them, of course. There's some CEOs that have been spectacular. But most of them are holding a seat, more concerned about what they're getting paid than what they're accomplishing for the world, and don't really transform in a positive way a lot of stuff. Some do. But the Business Roundtable is basically, more than anything, made up of corporate politicians. And I don't believe corporate politicians do a whole lot more for the world than regular politicians do. It's just another slice of kind of slick, erudite. I get really belligerent at times, and most of these people in their own ways are good at the politics that needs to be done to be able to stay in the position that they're in. But otherwise, in terms of actually doing business, most of them, not all of them, some are spectacular, most of them are just otherwise empty suits. Of course, that's just my opinion. I might be wrong. They just might all be great. Are we out of time? I am told I'm out of time, but I would like to thank you for listening to me. I hope you have a great day today.